system, the Indian stock market offers a plethora of opportunities for those willing to navigate its thrilling yet challenging terrain. If you wish to be a part of this success story, stick around as we share the top 10 tips for earning money from the Indian stock market. To begin with, it's essential to understand the basics of the stock market. The stock market is like a grand bazaar where businesses offer pieces of their companies, known as shares, for people to buy. When you buy a share, you essentially own a small part of that company. Now, how are these prices determined? It's a classic case of supply and demand. If more people want a particular share, its price goes up. If fewer people want it, the price goes down. But what affects the demand for these shares? Various factors come into play. Company performance, economic indicators, global politics, even weather conditions can influence stock prices. Think of the stock market as a living organism, constantly changing and adapting based on the world around it. It's a complex, fascinating system, and the more you understand it, the better investor you can become. Once you understand these basics, you're ready to start investing. One of the most critical steps in investing is researching stocks. You see, the stock market isn't a game of chance, it's a game of knowledge. A well-informed investor is a successful investor. So, how do you research stocks? Start by understanding the company. What does it do? Who are its competitors? How has it performed in the past? These are just a few questions to guide your research. Next, consider the company's financials. Look at its revenue, profit margins, and debt. This can give you an idea of the company's financial health. It's also important to consider external factors like the state of the economy, political stability, and industry trends. These can all affect a company's performance. Finally, don't forget to look at the company's leadership. Strong ethical leadership can be a good sign for a company's future. Remember, the more you know about a company, the better you can predict its performance. Another critical factor in investing is diversification. Imagine if you were to put all your eggs in one basket, and that basket unfortunately falls. Disaster, right? That's exactly what can happen when you invest all your money in a single stock. Now let's talk about diversification. It's like spreading your eggs across multiple baskets. If one basket falls, you still have others intact. Diversification, in the context of investing, means spreading your money across different types of investments, such as stocks, bonds, and cash. It's an effective strategy to manage risk. Not all investments will perform well at the same time. Some may be up while others are down. By diversifying, you're not relying solely on a single investment. Think of it as a balancing act. You're balancing the potential for higher returns against the risk of losses. And as the old adage goes, don't put all your eggs in one basket. So, spread your investments, balance your risk, and enhance your earning potential. Diversification helps you spread your risk and increase your chances of earning money. Investing in the stock market is not a get-rich-quick scheme. It's a principle that rings true across all investment platforms, and the stock market is no exception. The allure of instant wealth can be enticing, but it's crucial to remember that the stock market is not a casino. It's a platform for investing in businesses, and businesses take time to grow. Having a long-term perspective when investing in the stock market is essential. Think years, even decades, rather than weeks or months. This approach allows your investments to weather the inevitable ups and downs of the market. It also gives your investments the time they need to blossom and yield substantial returns. Consider the stock market as a tool for building wealth gradually, not overnight. It's about planting seeds today for a prosperous tomorrow. It's about patience, resilience, and faith in the economic cycle. Remember, the stock market is a marathon, not a sprint. Regular investments can help you build wealth over time. Imagine a disciplined approach where you invest a fixed amount of money into a particular investment at regular intervals, regardless of the price. This strategy is known as dollar cost averaging. It allows you to buy more shares when prices are low and fewer shares when prices are high, potentially lowering your overall cost per share over time. But why is this beneficial? Well, the stock market can be unpredictable. Prices rise and fall, often due to factors beyond our control. By investing regularly, you're not trying to time the market or predict the perfect moment to invest. Instead, you're taking a long-term view and smoothing out the short-term ups and downs. This strategy isn't about making quick gains, it's about steadily growing your wealth bit by bit over the long haul. So remember, making regular investments can help you take advantage of market fluctuations and build wealth over time. Investing in the stock market is not a set and forget game. It's a dynamic landscape, ever-changing, where the rise or fall of stocks can be influenced by a myriad of factors. So, it's crucial to keep a close watch on your investments. Imagine you're a gardener. Your stocks are your plants. You wouldn't just plant them and then leave them unattended, would you? No, you'd water them, check on their growth, prune them if necessary. That's exactly what monitoring your investments is like. Stay abreast with market trends, news, and developments. Study the performance of your stocks. Are they growing as expected? Are there any underperformers that need pruning? Perhaps some stocks are blooming and deserve more of your investment. Adjustments and tweaks are part and parcel of this process. They help you optimize your portfolio's performance, ensuring it's always in sync with your financial goals. Regular monitoring can help you identify opportunities and mitigate risks. Panic selling can be detrimental to your investment portfolio. Think of it like this: you're in a ship sailing on the high seas and suddenly a storm hits. You wouldn't throw all your cargo overboard at the first sight of a wave, would you? That's what panic selling is like. Panic selling happens when investors, driven by fear, sell their stocks during a market downturn. But here's the thing: markets fluctuate. They go up, they go down. It's their nature. Selling in a panic locks in your losses and can prevent you from enjoying the benefits of future growth. So how do you weather this storm? First, take a deep breath. Don't make decisions based on fear. Instead, stick to your investment strategy. If you've done your research and diversified your portfolio, trust in that. Remember, every storm passes and the sea becomes calm again. Remember, the stock market has always recovered from downturns. Patience is key. Sometimes it's beneficial to seek professional help. Enter the financial advisor, a guiding light in the labyrinth of the stock market. These are professionals with expertise in investments, financial planning, and wealth management. They can help you understand the intricacies of the market, analyze your financial situation, and guide you in creating an investment strategy that aligns with your financial goals. Investing in the stock market isn't just about buying low and selling high. It's about understanding market trends, knowing when to hold on to a stock and when to let go. A financial advisor can provide this insight and more. They can help you diversify your portfolio, balance risk and reward, and forecast potential market changes. There might come a time when the market's volatility becomes overwhelming, or when you need help planning for long-term financial goals. In such instances, consulting a financial advisor could be a game changer. A good financial advisor can help you navigate the complexities of the stock market and make informed decisions. Let's recap the top 10 tips for earning money from the Indian stock market. First, introduce yourself to the world of stocks and bonds. Understanding the basics is key. Second, put on your research hat. Dig into the financials of potential investments. 3. Diversify your portfolio. Don't put all your eggs in one basket. 4. Think long-term. Remember, Rome wasn't built in a day. Tip 5. Make regular investments. It's not about timing the market, it's about time in the market. 6. Keep a close eye on your investment's performance. 7. Avoid panic selling. Markets fluctuate, but patience often pays off. 8. Seek advice from a financial advisor. They can provide valuable insights and guidance. And finally, don't forget the most important tip. Patience, discipline, and understanding are your best friends in the stock market. Remember, investing in the stock market requires patience, discipline, and a good understanding of the market. Happy investing!